Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Varsha Chandnani, and we're going to be talking about onto a hospital company today. It's obviously inflation-proof to a certain extent from a business standpoint. It's also to a large extent geopolitical and tariff-proof as well. So you've got all of those largely not likely to impact something like this, and hospital companies have come to the forefront in a large fashion. It's a sector which has done extremely well over the last 12 to 18 months. You've seen a huge valuation re-rating, and therefore you'd want to understand whether that growth can actually sustain or not. And therefore what we're going to start with is trying to understand what I want to know with regard to this one. It's a KIMS that we're going to talk to, and we're going to talk about KIMS hospitals. And what I want to know is the first thing is that they have launched a lot of new hospitals, and all of that is impacting the numbers negatively. Mind you, from a business perspective where hospitals is concerned, you launch a hospital and it doesn't give you the best numbers in year one. The launch is more where the first and the second year numbers will reflect some bit of softishness. Thereafter is when the ramp up will start with regard to numbers, both on margins as well as on top line. And therefore what I want to understand is this trend of a taper down with regard to profitability, and we will look at those numbers and you'll see what I'm talking about. Is that going to change going forward? When do we see a ramp up on profitability as well as on average revenue per operating bed? This is a very common metric used for the hospital business in particular. Average revenue per operating bed. It is only the top line number coming into the hospital's kitty for every operating bed. So non-operating bed is not included, right? And this is termed as ARPOB. And ARPOB for a KIMS is growing substantially because they are growing in the markets where there is better revenue versus the markets where there is lower revenue, which they have traditionally been in. The third lever is occupancy. We spoke about average revenue per operating bed. Occupancy is a measure of how many beds remain unoccupied. So all of those factors is what you consider when you're looking at hospitals. Occupancy ramp up, and you will see that ramp up, as I did mention during the first metric. You see that ramp up in occupancy only from year 2, year 3 onwards. In year 1 you will see muted occupancy in most new hospitals, and therefore overall occupancy for the company as a whole has fallen. And are we likely to see a recovery there is my question. The fourth piece is with regard to margins and profitability. How will these two, therefore, given all of these metrics, how will these two metrics also move? And how do we see an increase there? The fifth piece is with regard to Capex. They've been doing acquisitions as well. They fund that through debt to a larger extent, and therefore you've seen a ballooning of debt as Capex has played out. They have revamped their strategy. They're trying to do asset light. They're trying to lease land rather than buy land, which is asset light. But nonetheless, how far are we with regard to the top of the cycle? And the sixth point, debt. Therefore, has it peaked? When will it peak? And at what amount? And the last piece is with regard to expansion beyond FY27. I'd want to know what the plans are, because till FY27 we have clear visibility on what they are doing. What about beyond that? So all of that is what we'll try to understand. Varsha, anything to add?
Yeah, no. So overall, the two major points that you have covered is, one is tariff proof. And because of that, a lot of analysts are also speaking about why they are bullish on hospital sector and even diagnostic sector. No Trump tariff, no jhanjat at all. The second thing is why hospitals are in focus is because of the Capex that they have been doing, and especially brownfield Capex. It's just an addition that you do to your building, or you just add floor or you just add beds, that's it. And because of that your ROE or return ratios improve. And one of the reasons why, investors or even analysts are bullish on hospitals because of the brownfield capex that these companies are doing.
Perfect. So I'll allow you to start with about this one in particular.
So starting with KIMS, that's Krishna Institute of Medical Sciences. So they are into hospitals and mainly they target Telangana and AP, although they are also expanding into other areas as well. They provide multidisciplinary integrated healthcare services, that is nothing but hospitals. Now let me just focus on the operating metrics. Now let me start with bed capacity, which has increased from Q1 FY25 to Q1 FY26 at 5,499 beds. Occupancy, if you see, has been lower. So it has dragged down from 56.5% to 48.8%. Now, one of the reasons is because of the addition of the new units that the company has done, and one of the reasons why you're seeing that drag in occupancy. Also wanted to talk about operational beds, which has of course increased from 3,500 to 4,612. Now, talking about ARPOB, that is average revenue per occupied bed, if you see, we've seen a healthy growth. Now, this is on the back of, so from 38,500 to 43,000. Now, the growth that you're seeing is because of the improved case mix and of course payer mix, which has led to this growth. And also, they have also guided from ARPOB growth of 4 or 5% in mature units. And at the consolidated level, this 43,000 number would go to almost 53,000 as their Thane and Bangalore unit ramp up. Now, moving on, if you see, let's talk about their Capex plans. So they've got huge Capex plan. So almost 1,800 to 1,900 of beds, they're going to add, which is, so for example, Bengaluru, if you see, the operation for this will be in Q2 FY26. So a lot of Capex that they are doing. And one question that we might want to ask to management, when of all this Capex will, add to top line? When we are going to see that huge growth in top line, because a lot of capacity expansion that the company has been doing.
And bottom line as well.
Yeah, and bottom line as well, and because that's under
with
pressure right now.
Yes, with a lag. Yes, yeah. You're right.
So, overall, so this is overall the business model and the Capex plan that the company has. And, I'll start with the income statement as well.
We can start looking at the metrics. And before we start, let's just quickly look at the metrics we'll cover. It's the regular, usual 8 metrics that we look at: income statement, balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, and valuations. We look at all of those 8. Varsha, income statement.
Yeah, so, starting with income statement, over here, if you see, the problem over here is net profit. Now, as Harsh was pointing out, this is because of addition of the new units. And because of that, if you see, your depreciation cost has increased, and your interest cost has increased, which has led to, this net profit pressure. So, revenue, if you see over here, it's 3-year CAGR is 23%, EBITDA 3-year CAGR is 15%, again, because of the addition of new units. And net profit impact that you're seeing is because of new units. Because of that, your depreciation cost has increased, interest cost has increased, which has, led to pressure in net profit. Talking about, let's talk about their Q1 FY26 performance also. Overall here, if you see, again, there's a problem, or I would say the margins. Margins have decreased. Over here, net profit has also decreased, though revenue has gone up 27%. If you see that, their margin trajectory, from 32% to 22%. Now, this is all because of the new units that they've been adding, and this is the reason why you're seeing this pressure in EBITDA margins. And, moving forward, we would see some increase in the margins going forward.
I just want to highlight, so your core mature markets, Telangana, etc., they do very good margins. They do 30% plus margins. So that's not where the problem is. The problem, or rather, you can't even call it a problem technically. It's part of the business, part of the growth of the business. As new hospitals get added, they are at lower margin. They are at single-digit margin, and therefore your blended margin comes down. And that's why you're seeing the shrink with regard to margins. That trajectory is not something which is unreasonably bad, but the question will be, how quickly can it go back up? really that is the question we'd want to address.
Exactly, right. So yes, overall, just in a nutshell, because of the addition of new units, we are seeing, pressure in the income statement, especially when it comes to margins and net profit.
Perfect. Let's look at the balance sheet. And when you're looking at it, largely the ratio of debt to equity is obviously elevated. And that elevated ratio is because they've done a lot of Capex. Varsha did put out that slide and presented it in about the company as to how the Capex is stacking up for the company. And a large part of this will peak in FY26 is what the management has said. I'd want to understand whether that is the case, how quickly does the pay down with regard to debt happen, and how can we move forward? What does FY27 and beyond look like from a balance sheet perspective? Because this is a large amount of debt which is sitting on the balance sheet. They've got a decent amount of cash as well. So in that sense, it's okay. You're largely seeing this to be a 30,000 crore company in market cap. And therefore, that 2,000 crore debt may not exactly bother me as much, but surely a 1:1, near 1:1 debt to equity is not something that is sustainable for very, very long. So you want to see it come off, if at all. So we'll wait and watch as to what the management says with regard to that. But cash flow, Harsha.
Yeah, so overall, cash flow, if you see, we would give here a thumbs up. In a hospital business, you don't have any receivables problems, you don't have inventory problems.
Clean.
Clean, exactly. Clean
Great
cash flow.
business to be in. You get the money before you get admitted. So there's absolutely no concern with regard to
exactly.
cash.
So no concerns when it comes to receivables and inventory, and that's the reason you're seeing cash flow from operation is a big positive number. Despite company investing, because if you see cash flow from investing, that has been increasing year on year. So in FY22 it was 412 crore, which has increased to 416 crore, which then increased to 753 crore, and in FY25 it increased to almost 1000 crore. This I'm talking about the investing activity. So company, despite investing huge amount in new units, we are seeing this positive cash flow because of the sole reason, no receivables or very slight receivables and no inventory. So overall,
and CFO to PAT is above 100% because you've got that very large depreciation number which is sitting in the P&L.
Exactly.
So you've got this super large, and I'll quantify it for you, it's 200 crore. Trailing 12 months depreciation number is close to 200 crore. This used to be at 70 crore in FY22. So you've got this very large bump up in the last 3 years with regard to that number, which is what is aiding the cash flow from operations to profit after tax. So that's something just to keep in mind.
So what was the pressure for income statement is a boon to cash flow statement.
Correct. Now let's look at return ratios. The return ratios have traditionally been elevated. They've been around 29-30%, but they've come off sharply, and that's understandable because you've got huge Capex that's coming, and you've got profitability which is playing out with a lag. So that's why. But even at likely a bottom maybe this year, next year, of 15%, even at its very bottom, not looking too bad. And therefore, we've given this one a thumbs up. Shareholding, Varsha.
Yeah. So overall, when I talk about promoters shareholding, it's like 34%. Now, one of the reasons why we have given a neutral rating to it, because we want that skin in the game. But the good thing is, look at the FII's stake. Though it has decreased by 1%, but good stake of FIIs at 15%. Even DII's stake is at 31%. So just because of that promoter's stake at 34%, we have been given this shareholding pattern as a neutral one. But FIIs and DII's stake gives us a confidence when it comes to KIMS hospitals.
Perfect. Now let me cover street cred as well as street coverage. Negative 1% last 1 month, but you look at the 6 month, year to date, 1 year, it's been a phenomenal run for investors. So very, very positive with regard to the way this has played out. And an investor who would have sat on this over the last 1 year over any time period has done very well. So that's the positive. 5 years as well. In fact, it's not listed since 5 years, it's listed since 2021. Since then also, it's given a very, very good performance from a stock price perspective, and therefore we've given this a thumbs up. No concern from a shareholder perspective given the kind of returns it has given. Valuations, trade coverage, let me try and cover that as well. 14 buy calls, 1 hold, 3 sell, 15% upside. and therefore a thumbs up on that as well. From here, another 15% is what analysts are penciling in. Clearly bullish on this one. Varsha, but valuations.
Yeah, so valuation, if you see at a P level in for FY26, it's at 68 and FY27 47. Now, this kind of a premium kind of valuation that the company has been given. Now, one of the reasons is we may see a growth in ARPOB. The occupancies tend to increase. That's a positive point. ARPOB growth is a positive point, and the company is doing a lot of Capex, which will turn into good growth when it comes to net profit. So because of all these positive points, the company is trading at a premium valuation. Because if you see for Max Healthcare, for FY26 is trading at 67p, for FY27 at 53, right? So it's not like, it's very close to, the valuations are very close to Max Healthcare, because Max Healthcare is a giant when it comes to hospital, considering the good ARPOB that the company has, good occupancy. And one of the interesting thing in Max Healthcare is they are doing a lot of brownfield Capex, which will enhance their margins, which will enhance their ratios. And so KIMS has been given that valuation to the level of Max. Even for Yatharth Hospital, if you see, is at 37p, FY27 26p. So overall, because of all these things, KIMS has been given a premium valuations.
We have Dr. Bhaskar Rao, who's Chairman Managing Director at KIMS Hospitals, joining us. So great having you. So let me start off with what changes in FY26, because you are likely guiding for an uptick with regard to margins. You feel margins have bottomed, and therefore I would assume that some of the less profitable hospitals are going to start to see a better churn, and the newer ones, of course, and understandably so, are going to start to see better profitability. Give us that perspective. Where does it lie? Do we go back towards 25% quickly enough in FY26?
Yes, what's happening when the organization, especially it is an healthcare organization, when it is running and building a good brand image among the patients, what we do and attract is a lot of complex cases. When you get a lot of complex cases, whether they're tier 2 cities or tier 1 cities, the ARPOBs will increase. That is one aspect. The second aspect is we have been started Thane, Bangalore units this quarter, and that will usually takes about 12 to 18 months in a healthcare industry. I am expecting at least 9 to 12 months we can able to see the positive bottom line. So that will also improve the margins and as well as the revenue and ARPOBs also. You can able to push the ARPOBs because both Bangalore and on Thane, they are the little high ARPOBs, is almost like Telangana, even better than Telangana ARPOBs. Whereas Andhra ARPOBs are very, very low. Even in Andhra, we are also adding an additional beds in Srikakulam, Anantapur, Ongole, and Rajahmundry. These are also matured now. The occupancy is very high. When we are doing like that, then definitely those margins also will increase. So this year looks, and the coming year also, very, very positive outlook. I'm seeing I can believe I can do a better job than what we have been doing historically.
Hi, Mr. Rao. This is Varsha this side. Pleasure to have you at NDTV Profit. About ARPOB, I'll just extend that. From 43,000, can we expect ARPOB to go 50,000 to 53,000? And if yes, by when are you targeting that number?
There is nothing like we target. Basically, as I mentioned before, if the complex cases comes and the high-end margins that are there in Thane and Bombay, 43, there is a chance it can go even to that level. But definitely year on year, there will be definitely a better prospects on the ARPOBs are concerned.
So, but you've guided, if I'm not wrong, for an ARPOB of 50 to 55,000. You've done 43 in Q1. How likely is it that you get there?
Fair chance, very fair chance.
Okay, and what is it that gives you that bullish construct? Because the kind of bridge between 43 and 50, 55 is quite large. So what is going to change so dramatically over the next maybe 9 months that gives you that optimism that you will get there?
See, the reason is 900 beds what we are opening this year in Bangalore and Thane. And these are all the very, very high ARPOBs than Telangana cluster. So that's where whatever margins that is going up, it will be able to show the Thane one is doing a good job. And then this quarter, maybe the third quarter of this year, the Bangalore units will start. It will take about 2 quarters, most probably, if not the end of this year, in the next financial year, about quarter 1, there should be a good jump of ARPOBs.
So you're doing a lot of Capex, and maybe this Capex will go on for next 2 years. Just wanted to understand what is the peak revenue, that KIMS may see for next 2 to 3 years, because if I'm not wrong, you're adding almost 1800 bed capacity in the next 2 to 3 years. So just wanted to have that ballpark number, if you could give us beyond FY27, how KIMS will look like.
So there will be definitely 25 to 30% revenue growth year on year in the next 3 to 4 years.
Okay, and also, sir, just wanted to, revenue is 25 to 30% CAGR that you're targeting. What about margins? Because we've seen some pressure in margins now, of course, because of the addition of new units, but any kind of target that you have set for yourself when it comes to margins, maybe, in next 2 to 3 years?
See, basically, whatever is the matured healthcare, when we are running it and understanding the operational efficiency, and when we set all these things, initially it will be down, and then once it is matured, and then we will be able to see what we are looking around 22, 23 margins. Financial year 22, we are expecting to reach that, because there is no reason why it should go down. When we are matured enough, the margins will be more of operational efficiency, talent that is available, and the very, very reasonably we set up the Capex. When these are all having been a 2.5 decades, we are in the field, and we understand that what we are doing is, and when we are moving forward, the organization becomes bigger and bigger. There will be again an operational leverage of bringing down the cost of the expenditure. So the margins will be able to sustain what we have been achieved before.
It's a great conversation. So I want to understand where and when do you peak in terms of your Capex? Because, and this is from a perspective of debt, you've guided that your debt will peak in FY26. What will that debt number be? What is it that you're comfortable with in terms of your debt number? And where does your Capex, for the moment, pipeline end? In what quarter does the cash flow going out from your business stop, so that I understand where the debt will peak at?
See, here there is 2 things which we need to be able to say rather than talking about the debt. If you look into the debt on the listed company, is very, very low. Even hardly about 600, 700 crores is the debt when we are taking about the similar amount of EBITDA. Whereas we have a lot of subsidiaries, where the subsidiaries are putting on expansion, like in Bangalore is another subsidiary, and then we have Srikakulam, we have Anantapur, all these subsidiaries, Kurnool, where we are doing an expansion of bed capacity. There we borrowed the loan. That is the reason it is coming into the debt looks like very huge. If you look into the listed company, the even it is less than 1 is to less than EBITDA to debt will be hardly less than 1. Whereas because we added those units, because we have taken a long-term debt of 10, 15, 10, 12 years, that's why the debt is showing that, but it is not at all an alarming position of the debt. Listed company is the most important, which we need to look into the debt. It is less than 1:1 of the EBITDA. When it is less than 1:1, if the subsidiary is having any issues, we can able to support it. So we are very, very careful about how this listed company debt will be less than 1:1, whereas in the Other things it will be around 3, 3.5, but average blend will be around 2.5. We will be very, very cautious even in the on the whole. I want to keep the debt 1:2, EBITDA to debt. Maybe that once we come by 27, it comes down. From there, when we are able to put the capex, we will be very, very careful to, we should not cross more than 2 max. 2 max.
Understood, sir.
Preferably to be less than 1.5.
Understood. Thank you so much, sir, for coming in and speaking with us. This has been very, very insightful, not just from a KIMS perspective, but also from understanding hospitals. Viewers, it's always great understanding a different sector and you know, completely changes the way in which we look at the metrics as well. But anyway, that's all of our KYC metrics. It gives KIMS Hospitals a 6 out of 8 on our KYC ratings. Mind you, 30% growth for the next 3 years will mean that your top line goes from 3,000 crore to 6,500 crore in 3 years with a margin closer to 30%, which will likely mean around 1,900 crore in terms of EBITDA, and currently trading at around 16 times EBITDA if we look at the next 3 years. But of course, 3 years is a long time. So you also want to be careful with regard to that. How far are you extrapolating it? But viewers, completely out of time. From Varsha, myself, everyone who puts the show together, thanks so much for watching.